You won't believe what's happening behind the scenes in crypto right now. Big banks like Standard Chartered are officially setting up Bitcoin and Ethereum trading desks for their clients. At the same time, Ben Cowan is warning that while everyone is screaming alt season, altcoins might actually get crushed against a strengthening Ethereum, especially with its own spot ETFs on the way. Speaking of which, Crypto Jeb sees this ETF fuel pushing Ethereum to as high as $11,500. Even Telegram is getting in on the action, turning its app into a massive, easy-to-use crypto wallet for millions. But with Bitcoin dropping and Solana at a make-or-break price level, is this the start of a huge run-up or just another trap? The smart money is making moves, and you need to know what they are. In the latest video from Altcoin Daily, the channel suggests that the crypto market is on the verge of a massive upswing, and many investors aren't prepared for the scale of what's coming. The argument starts with the global M2 money supply hitting another all-time high, a historical indicator that often precedes a Bitcoin price rally. The main force behind this expected surge is the entry of Wall Street, nation-states, and other institutions with serious capital. Even with their recent buying, they're still considered underallocated to quality crypto. The video does a great job of capturing the extreme optimism currently circulating in the crypto community. The core idea that institutional money is still largely on the sidelines is a powerful one and has been a central bull case for years. The launch of spot Bitcoin and Ethereum ETFs in the US has turned this from theory into a measurable reality, and the inflow numbers mentioned are a testament to that. It's interesting to see the focus shift slightly to Ethereum with the argument that its utility in DeFi and tokenization, combined with the new ETF demand, creates a supply squeeze that could drive its price up faster than Bitcoin's in the near term. This isn't a new idea, but it's gaining a lot of traction again. While the price targets from ARK Invest and others are exciting, they represent extremely bullish long-term outlooks. The video's overall message is clear: the financial landscape is changing, and digital assets are becoming a more integrated part of it. In the latest video from the Crypto Rover channel, the discussion centers on a peculiar market situation. Bitcoin is dropping below a critical support level, yet Ethereum is gaining strength. The host sees this as a textbook signal that an altcoin season is just around the corner. While his own trades in Cardano, Dogecoin, and Bitcoin are at a slight loss, he's holding on because he's convinced a push higher is coming, especially for Ethereum. This idea of a capital rotation from Bitcoin to Ethereum is a hot topic right now. It makes a lot of sense on the surface, especially with the new spot Ethereum ETFs expected to launch soon. While Bitcoin ETFs got all the early attention and inflows, the spotlight is definitely starting to shift. The video's point about smart money accumulating Ethereum while retail sells is a classic narrative that often precedes a big move. It's compelling to see data like BlackRock's growing ETH holdings backing this up. The biggest question in my mind, though, is whether the actual launch of the ETH ETFs will pour more fuel on the fire or turn into a buy the rumor, sell the news event. The market has been building this anticipation for weeks, and it'll be fascinating to see if the momentum can be sustained once the products go live. In the latest video from the Crypto Tips channel, they break down how to hunt for those elusive 100x crypto projects. The first big point is that if you're hearing about a coin from a major news outlet or a huge influencer, you're probably too late to the party. The real opportunities are found before they hit the big exchanges. The video suggests looking at crypto launchpads like DAOmaker and Binance Launchpad, checking the newly listed sections on CoinMarketCap and CoinGecko, and using on-chain data tools like Nansen and Arkham to follow what savvy investors are buying. One of the most overlooked methods is checking a project's developer activity on GitHub. If no one is building, that's a bad sign. This video gives a solid, evergreen framework for looking at new crypto projects. The emphasis on checking the team, the token supply, and actual development on GitHub is spot on. It's the basic homework that many people skip. What's interesting today is how some of these concepts have evolved. For example, while the video mentions following smart money with on-chain tools, that has become much more common. Now, thousands of people are watching the same wallets, so the advantage isn't as big as it once was. The narratives mentioned are still very much in play, especially AI and RWAs, but the market has also seen explosive growth in areas like DePIN, decentralized physical infrastructure, and a wild resurgence of meme coins on chains like Solana and Base, which often defy the must-have a use case rule. It shows that while fundamental analysis is a great shield, the market can sometimes reward pure hype and storytelling, at least in the short term. In the latest video from Lark Davis, he looks at where Solana's price might be heading. Right now, he says the most important price to watch is $185. He explains that if Solana can close above this level, especially for the week, we could see a quick push towards the $240 mark in the next few weeks. However, if the price gets rejected at $185 and it becomes resistance, things could turn bearish in the short term, with prices possibly dropping to the $175 to $155 range. It's interesting to see the focus on the $185 price point, which has been a clear battleground for Solana lately. My own take is that the institutional angle Lark brings up is probably the most powerful force at play here. The discussion around ETFs is only getting louder, especially with major players like VanEck recently filing for a spot Solana ETF in the US. This goes beyond the futures product Lark mentioned and could open the floodgates for a lot more capital. On the technical side, the progress of the Firedancer upgrade is another huge story. If it successfully improves network speed and reliability, it will address one of the biggest past criticisms of Solana, making it an even more attractive platform for developers and large-scale applications. While price targets like $750 seem high from here, the combination of real technical improvements and serious institutional interest makes Solana's potential hard to ignore. In the latest video from the Ben Cowan channel, he breaks down the current state of Bitcoin dominance and what it means for altcoins. For a while now, dominance has been on an upward march, and it just recently got rejected from the 66% level. Cowan notes this was expected, as dominance tends to struggle at these major levels on its first try. Each time this happens, people get excited and call for an alt season, but they've been wrong every time so far. From my perspective, Cowan's analysis lines up well with the current market mood. The expected launch of spot Ethereum ETFs feels like a major catalyst that supports his thesis about ETH's strength. As institutional money gets ready to flow into Ethereum, it makes sense that ETH would outperform smaller, riskier altcoins. We could see a scenario where capital rotates out of alts and into ETH, causing the bleeding that Cowan talks about to get even worse. At the same time, recent outflows from Bitcoin ETFs suggest some traders are feeling cautious. If Bitcoin consolidates or dips slightly, as it often does in late summer, it could easily trigger the sharp altcoin drop Cowan predicts for October. It seems the market is setting up for a blue-chip rally in Bitcoin and ETH, leaving most other altcoins behind for now. In the latest video from Coin Bureau channel, Nick gives a straightforward breakdown of the biggest spot Bitcoin and Ethereum ETFs. He starts by explaining that a spot ETF is a fund traded like a stock that is backed by actual crypto, unlike futures ETFs, which are based on price derivatives. This makes them accessible through regular brokerage accounts, but it also means you don't personally hold the crypto keys. The video points out that access varies by region. U.S. investors can easily buy these ETFs, while European investors often need to use alternatives called ETPs, exchange-traded products. In the UK, retail investors are currently restricted from buying either. My take is that the initial frenzy over the spot Bitcoin ETF seems to have settled into a more predictable, albeit volatile pattern. For weeks, the narrative was all about unstoppable inflows, but recent news shows a streak of net outflows, which brings a dose of reality to the market. It shows these products aren't a one-way ticket to higher prices. The real story to watch now is Grayscale. Their high-fee G Bitcoin is bleeding assets, yet they launched a low-fee Ethereum mini trust. This feels like they're testing two completely different business models at once. As for the Ethereum ETFs, they haven't really had their moment yet. The market is still waiting to see if they can attract the kind of serious capital that the Bitcoin ETFs did, especially with the ongoing discussion about whether they'll be allowed to offer staking yields. That feature could be what truly sets them apart and determines their long-term success. In the latest video from the Crypto's Rush channel, the host talks about the recent drama surrounding a supposed visit by Trump to the Federal Reserve. He describes a funny but tense exchange between Trump and Jerome Powell over the Fed's renovation budget. Trump claimed the cost was $3.1 billion, but Powell quickly corrected him, pointing out that Trump's number included a separate building project completed 5 years ago. The real budget is still a massive $2.5 billion. The host uses this to talk about huge government overspending, noting that building the Burj Khalifa cost only $1.5 billion. This kind of spending is exactly why people are looking for better assets like Bitcoin. It's interesting how the video builds a narrative around a Trump versus Powell showdown at the federal. While the core issues, the Fed's massive renovation budget and ongoing political pressure on interest rates, are very real topics of debate, the specific event of Trump visiting the Federal Reserve for an on-camera confrontation over the budget appears to be a bit of creative storytelling. Public records and news reports don't show this visit actually taking place. Still, the underlying point about government spending running wild is spot on. Using the Fed's $2.5 billion renovation as a prime example really puts the scale of government expenditures into perspective, making the argument for alternative assets like Bitcoin feel more urgent and less abstract. In the latest video from Crypto Wendy, she talks about how Ton Wallet is transforming Telegram into a full-blown crypto application for the 2025 bull run. She explains that this isn't a separate app you need to download. It's built directly into Telegram, making it incredibly easy to use. The wallet, which is built on the Ton blockchain, just became available to 87 million Telegram users in the US. It's a self-custodial wallet, meaning you hold your own keys, but it offers a handy email backup option. Wendy points out some of its best features, like being able to send crypto like USDT and NFTs directly within a Telegram chat, just like sending a message. You can also buy USDT with no fees using Apple Pay or credit cards and, more importantly, withdraw your crypto directly to a bank card. This easy off-ramp process is presented as a major advantage for bringing new people into crypto. She suggests it's becoming a real competitor to apps like Cash App and Coinbase because of its simplicity and integration. You can activate it by going to wallet.tg inside the app. My take on this is that the integration between TON and Telegram is becoming one of the most interesting stories in crypto. It's not just a simple partnership. Telegram is actively pushing its user base toward the TON ecosystem. We recently saw this with the ad revenue sharing program, where channel owners get paid in Toncoin. Then there was the viral success of Notcoin, a simple game inside Telegram that onboarded millions of users to the wallet. These moves show a deep commitment from Telegram to make TON its native Web3 layer. It feels less like a speculative bet and more like a deliberate strategy to turn its massive user base of over 900 million people into active crypto participants, which could have some really interesting effects on the market. In the latest video from The Modern Investor, the host covers the growing wave of companies and banks jumping into crypto. He starts with Standard Chartered, a big London-based bank, which has just launched spot Bitcoin and Ethereum trading for its corporate clients. This service will initially run during Asian and European trading hours, but they're thinking about expanding to a 24/5 model. The host thinks this shows how traditional finance is being forced to adapt to crypto's 24/7 market. Next, he talks about Animoca Brands, a company known for gaming and Web3, which is teaming up with DDC Enterprise to put $100 million into its Bitcoin treasury. He points out that $100 million buys are becoming normal, and he believes companies are rushing to buy Bitcoin before the price climbs even higher, making it more expensive to reach their accumulation goals. The final story is about a Japanese firm called Remix Point, which will now pay its CEO's entire salary in Bitcoin. While the host notes that others, like athletes and mayors, have been paid in crypto before, this is a big deal for a public company in Japan and likely a sign of things to come. The video does a good job of stringing together recent events to show a clear pattern. The Standard Chartered news is particularly significant. This isn't just a small-scale pilot. It's a major global bank setting up a dedicated trading desk for institutional clients. This move suggests they anticipate serious, long-term demand from their corporate customers who want direct exposure to Bitcoin and Ethereum. It's a sign that crypto is becoming a standard asset class for big business. The Animoca Brands decision is also quite telling. A company that is on the very edge of digital innovation with Web3 and the metaverse is choosing to anchor its treasury in Bitcoin. This shows they view Bitcoin not just as a speculative investment, but as a foundational reserve asset for the emerging digital economy. It's a powerful statement when a forward-looking company decides the oldest cryptocurrency is its best bet for a stable treasury. In the latest video from the Crypto Jeb channel, Jeb explains why he believes Ethereum could reach as high as $11,500 during this market cycle. He starts by pointing out the huge amount of money flowing into Ethereum ETFs, which he says have already pulled in $9 billion, far more than the gold ETFs did in their first 2 years. He draws a comparison, noting that gold rallied 300% after its ETF launch, which would put Ethereum on a path to $10,000. On the technical side, he's optimistic because Ethereum recently bounced from the $3,500 support level. He identifies this as the Fibonacci golden pocket, a sign that an asset is likely to return to and break its previous all-time high. If ETH stays above $3,000, it could complete a pattern that points to a $6,500 price. Jeb also talks about the growing stablecoin market on Ethereum, which is currently at $132 billion. He thinks this growth will increase network fees and drive up ETH value. Based on all this, plus Fibonacci extension models, his final prediction is that Ethereum will land somewhere between $7,500 and $11,500 in this cycle, especially since he believes the real alt season hasn't even started yet. Jeb puts together a very bullish case for Ethereum, and his reasoning around network fundamentals like stablecoin growth makes a lot of sense. The point about ETF inflows is interesting, but it's worth noting that the massive wave of capital he's anticipating is tied to the US spot ETFs that were just approved but haven't started trading yet. The inflows he mentioned from farside.co.uk are likely from existing global products. The launch of the US ETFs could be an even bigger event than what he's describing. His technical analysis on the $3,500 bounce is solid, as many traders are watching that level. While the $7,500 to $11,500 price target feels ambitious, the catalysts he mentions are real. It seems less a question of if these factors will affect the price, and more a question of when and how strongly the market reacts once US trading begins.